Right, good evening everybody. Matthew Gilligan speaking. Welcome to Gilligan Rose Tax Changes and Property Update. This evening's going to run from 7 p.m. till probably 8:30ish. I'm joined this evening by Anthony Lipscombe, who is a tax director here at GRA and long-standing employee, 15 years now at GRA. He's a lawyer and a chartered accountant, and he'll be working through Q&A with me, but later in the night. Welcome, Anthony. I think you're in the background there.
Yeah, thank you. I will remain in the background until you need me.
Thank you. For those of you that don't know me, I'm managing director here at GRA. I'm a chartered accountant specialising in tax and legal structures, but I'm also a property developer and property investor. And it would be fair to say that in recent years, I've spent more time investing than I have in the business of being a chartered accountant, which is one of the reasons why people choose GRA as their advisors in property, and that is that we are people who practice what we preach. We do what we say we're doing, and from that you can observe what we're doing and, if you like, copy what we do and get what we get. At the moment, I've got around 30 properties in the Auckland market that I own. Some of those are joint venture properties. Some of those are development properties, which is a particular focus of my property investing since the advent of the unitary plan. So my property portfolio is something that I expose to clients, let them look at, and I encourage them to copy what I do, because we're all about our clients making money out of property. I ran some stats here for you just to entertain you while I was preparing for the presentation. And interesting to see New Zealand. I guess it's what I would have expected to see at this stage, 2018, where seeing the effect of ripple effect. Auckland tends to boom first every cycle, comes off the boil first and starts to go down. Because it's so unaffordable and it's boomed first, it's pushing population out of Auckland into the regions. And so that downshifting movement where ripple effect is pushing people into the regions mean they tend to come on the boil as Auckland comes off the boil. And I've got a bit more information here that I'll do after the tax discussion, but there was just a bit of information there for you to look at. That data is from REINZ, really just saying that Auckland's off the boil. Things are still selling. House prices are pretty flat. Rest of the country's probably firmer than the Auckland market is and coming on the boil. But more about the property market changes a bit later. So this evening, we're going to start with tax changes and topical tax issues, and that's going to be the main focus of this evening. We'll go through the taxes, and then we'll have a quick look at the Auckland property market. And for that, rather than looking at data, I'd just like to read to you some notes I took from speaking to 3 real estate agents who are prominent real estate agents in Auckland, who are top earners for Barfoot's and Thompson and Ray White, and just give you a bit of feedback on what's actually going on out there. Just a thing to be aware of is that Gilligan Rowe run a 6-monthly event called the Property Leaders Event. It's a 1-day event, and the next one is on the 27th of May, Sunday the 27th of May, which is a couple of weeks away now. These are really good events. We try hard for them. A lot of data in the events where we really deep dive into what's going on in property, and I cover that off. But we also try and present strategies that are relevant to this current environment, and so we'll be going over property strategies that are working. And in that regard, we'll be hearing from Tuasa Sevi, who is an Auckland Property Mentors mentor. That's a Gilligan Rowe company, Auckland Property Mentors, which we partner with Tua in. And Tua is a trader and a buy and hold investor. Excuse me, my voice is suddenly going. So Tua is a trader and investor, is very plugged in, and we'll be hearing from him exactly what's going on and where the money is in Auckland at this event. And a number of other speakers, including Tony Alexander, the BNZ chief economist, will be there. Ashley Church, the Property Institute's CEO, and finance and tax discussions from Chris Peterson and Janet Sukoa. And Saleesh Chand, who's a bit of an up-and-coming star. He's made $5 million in the last 5 years out of property. And so we'll be hearing from him on how he did it and what he's been doing. So interesting event, May 27. Check it out online. There's the address. Okay, let's start talking tax. So firstly, 5-year Brightline rules. These have now come in from March 29th and are now in effect. Labor, of course, said that they were going to do this, and they've come through and, true to their word, put these rules in. And they're a little bit more complicated than they look, and they have deeper implications for investors than you might otherwise think. At a veneer level, they seem quite simple. So there's two dates to consider. Firstly, the acquisition date, and secondly, the start of the 5-year clock or 2-year clock, depending on your date of, goodness, my voice is picking up, depending on the date of acquisition. So, acquisition date. This is the date you are deemed to have acquired an interest in land. And this is the conditional sale and purchase agreement date, effectively, which is, I thought it was unconditional, was my, historical sort of view of this. But in fact, it turned out when I dug into the deeper text on it that it's actually when you have a conditional sale and purchase agreement, in other words, an interest in land. This is sort of a transitional issue, really, because what it's determining is whether you have the 2 or 5-year rules applying. Essentially, if you have agreements dated to prior to the 29th, you're under the 2-year rules, and thereafter the 5-year rules will apply. So it's really just a transitional issue. What was your acquisition date? It determines which clock you get. Do you get a 2-year clock, or do you get a 5-year clock ticking? So the clock start is the next date you've got to think about, and this is the settlement date. So pretty clear here, it's the day you settle is the day that the clock starts. There is an exception to this, and that is if you buy off the plans, the acquisition date is actually the date that you that you gain a conditional sale and purchase agreement. So, for example, if you buy an apartment or a house or a section, 2 years delayed settlement, then the date that the clock starts ticking is the date that you sign the sale and purchase agreement. So that can change, of course, how long you have to hold the property for. But the general rule is if you sign a property up under sale and purchase agreement and you've signed it after March 29th onwards, then you're under the 5-year clock, which are the new rules. So let's just have a case study to make the point. Let's look at Jim, Bob and Sue Ann. They recently migrated to New Zealand from Alabama, and they purchased an investment property for $500,000 in Auckland. And on the 15th of March 2018 was when they purchased that. In other words, they signed the sale and purchase agreement, and then they settled on the 5th of April 2018. And as luck would have it, the property zoning is advantageous, and the vendor didn't realise this. They sold the property to them, and it turns out they could actually build 5 houses on the property, and it's worth $1.25 million. So Jim Bob owns this property, rents it out, and 18 months later, he buys another property, which is going to be his home, for $750,000, and he wants to make his debt tax efficient. So these are the facts. Jim Bob and Sue Ann have bought a rental property in effectively March 2018, settled April. It's a high value property that's gone up in value. They've managed to get a real bargain. And then 18 months later, they're buying another property, being a family home, for $750,000. First question is, what rules apply here? And you would now be required to think. When did they acquire the property? Going back to the facts, they signed the property up on the 15th of March, and your acquisition date, of course, is the date that you signed the sale and purchase agreement. So this is signed before March 29th, so the 2-year rules apply. The next question is, when does the clock start from? In other words, how long do they have to hold the property for from the date that they purchased it, and this date will be from the date of settlement, which is April 5th, 2018. So 2 years from this date. So what rules are you under? That's on your acquisition date, which is your sale and purchase agreement. And when does the clock start for the rules, which are in this case 2 years? It's from the date of settlement. Okay, so Jim Bob now goes to ABC Accountants Limited, who recommends that he urgently goes to his mates at Super Duper Mortgages Limited to optimise debt deductibility. Because remember, the context of this is he's just bought a family home, and he now wants to work out how he can make his debt tax deductible. And we're considering how those Brightline rules on the original rental property he purchased might be affecting his options for restructuring. So he's doing this in October 2019. It's next year plus 6 months. And the question we have is, how can he make the interest on the debt required to purchase their new home tax deductible? That's the question he asks ABC accountants, who then recommend he goes straight to his mates at Super Duper Mortgages. And so this is his current position. He's got a proposed new home and he has to borrow $750,000 on the home. And his existing rental property, we'll say he's borrowed $250,000 on it. It's worth $1.25 million, so he's got $1 million worth of equity. So what Super Duper come up with is they say, why don't we set up a look-through company? Why don't we move the rental property that you own into the look-through company at market value, which is $1.25 million, and then we can go and borrow the existing debt on that property, which is $250,000, and we can borrow another $750,000, which is the debt required to settle the new home, and so you'll have a full $1 million worth of debt in the look-through company and no debt over the family home. So in other words, all of the debt becomes tax deductible in the LTC because it's incurred in that entity as a result of that entity acquiring the rental property. So that makes the interest tax deductible on transfer to that entity. So what are the consequences of this restructure? And you know, this has been done forever and a day. This is a very common thing to do, and I'm sure that most of you know about this restructure, or many of you will know about this restructure opportunity. But what you may not have thought about is, you know, what are the tax consequences from a Brightline perspective of this transaction? Remember, the rental property was acquired on the 15th of March. And we're doing this transaction on in October 2019, which is 18 months out. So I'm going to put a quick poll up here. What we're doing is we're selling a property to a related party. And my question is this transfer of the property to the look-through company taxable? So I'd just like you guys to vote on this. So we're selling the rental property to the LTC. Jim Bob is selling property across. What do you guys think? I'm seeing it on the screen here. So if everybody could just go to votes. It's only open for another 26 seconds. If everybody could go to polls, which is in the top right corner of your screen there, and click the down arrow, you should be able to see the poll. 60% of you have voted. 65% have voted. And we'll close it off in 3, 2, 1. And 71% of you voted, well done. And 76% of you, so there's 370 of you online, and 76% of you say yes, it's going to be taxable on transfer, and 24% of you say it's a no. Well, it's a residential property. It's not your family home in this circumstance, and it's sold within 2 years of the date of acquisition. So what you have is a taxable gain on a related party sale. So it's been sold for $1.25 million. It cost you $500,000. So Jim Bob and Sue Ann will have a taxable gain of $750,000, which will cost them $250,000 in tax. So this will be a shock to lots of the members of the professional community, because there's a lot of this been done across the years where assets get moved around to get a step up in value so that you can take private debt over the business asset that you're moving into the company and get a deduction for it. And that's going to be fraught with risk now, because this property was under the 2-year rules being purchased prior to March 29th. But when you think about it, a lot of property is going to be taxable for 5 years moving forwards. So this is going to be a real problem for professionals. So for the professionals listening, you guys have got to be careful, because you're going to be sued for negligence on this. And for the investors out there, just be careful. Make sure you support your professionals with bringing this to their attention, because it'll take a while for the tax and legal community to get up on this sort of thing. We're already seeing examples of professionals making mistakes in this area. So what should Jim, Bob and Sue Ann have done? What should Super Duper Mortgages and ABC accountants have said? They should have firstly given the advice that the transfer would be taxable. Secondly, they should have said, let's wait 2 years before considering this debt restructure. And of course, everybody should be aware it's going to become much harder. So here's another question for you. This question is, Jim Bob purchases a commercial property in May 2018. He acquires it for $2.3 million. And he rents it out successfully by splitting it into two and increasing the rent $100,000 as a dual tenancy property. He gets an extra $100,000 of income, and at a 5% cap rate, the value goes up by $2 million. So it's worth $4.3 million. In 2022, Jim Bob divorces Sue, sadly, and he sells the property to fund the divorce payout. And the question is, what are the Brightline tax implications of this? And I don't know if I can run that poll again, but no, I've closed that poll, so I can't run it again. But the trick here is to understand that Brightline rules apply to residential property. And this is a commercial property. So no tax to pay on commercial property gains under Brightline rules. Of course, you'd have to consider the implications of general taxing provisions that say that if you buy a property with the intention of resale, or you're associated to a dealer in land and property which taints you, all those sorts of rules could give rise to a taxing obligation. But in this circumstance, Jim Bob's a long-term investor, and he's simply adjusting his position as a result of cash flow pressure resulting from the divorce. So you wouldn't expect there to be tax to pay on that. We've got no capital gains tax in New Zealand at the moment. So no Brightline rules implication and no tax to pay on that transaction. Right, let's now talk about emerging policy, which is capital gains tax. And of course, Labor said in the election that they won't bring capital gains tax in for this election cycle. They would convene a tax working group, which has been convened. Michael Cullen is the chair, and there's a number of academics and Big Four and Big Law representatives on that group. And so they are convened, and they're considering what will be the fairest tax system for New Zealand. So at the command of Labor, part of that will be considering whether capital gains tax is appropriate for New Zealand. And I think it's kind of a foregone conclusion that we're going to get a recommendation for capital gains tax. The last working tax group that was convened recommended capital gains tax. New Zealand is the only OECD country that doesn't have a comprehensive capital gains tax, although we do have some elements of our tax base that are a backdoor capital gains tax. We don't have a comprehensive capital gains tax system. One could argue that the 5-year Brightline rules are a capital gains tax on property sold within 5 years. But we certainly don't have a capital gains tax that is analogous to what OECD countries overseas have. It's likely, if this group recommends it, that the government will do what they said in the election, which is draft rules that will be published this election cycle, and if they are re-elected, they will become effective from Labor's second term in government. This is what they've said they'll do. I think while the tax working group has got many options available to it, one of the elephants in the corner that I think will come out of this review is stamp duty must rear its head as part of CGT discussion. When you look overseas, most tax jurisdictions that have capital gains tax in place tend to bring in stamp duty with it. It's particularly favoured amongst countries with high house price inflation, for example, Australia and Canada, both have stamp duty, and the UK. So that'll be very recessionary if stamp duty comes in, because if you think about it, at the moment we can borrow 65% as property investors, 80% as homeowners, and so you need a 35% deposit. If you buy a property for $1 million, you need $350,000. Well, if stamp duty comes in, it's typically around 5%. You'll need an extra 50 grand to buy the same amount of property as you could before. So it'd be very recessionary because you can't borrow the stamp duty. There's no increase in market value from paying stamp duty, so the bank won't leverage against it. So to do the same amount, you suddenly need an extra $50,000. So a few things about how CGT might be applied. And just to pause and say, this policy is a long way off. We haven't yet had the working tax group say we're going to bring in CGT, but I think we will see them say bring it in, and there's certainly an appetite from the government to do it. So to start thinking about how this will work, we have to look back to the election prior to the last one that Labor won to get a little bit more detail on what they were saying about it at that stage. And what they said is that if they bring in CGT, there'll be a V-Day or valuation day on the day that the election, the day the tax starts, which would be their next election cycle. And on V-Day, the existing asset values would be your cost basis for CGT. So if you bought a property for $200,000 20 years ago, and today it's worth $1 million, and today's V-Day, then it's the gains over and above $1 million that are taxed, not the gains based on historic cost. So it's profits after V-Day becoming taxable. So I guess the key thing from a planning perspective that everybody's going to need to be considering is getting the highest possible market value. So in some circumstances, you'll find that the CV or rateable value will be higher than the market value. So the investors will be looking at what the CV is going to be versus the market valuation and choosing and picking the highest one, no doubt. And that will be the most important thing to do, because if you just leave it to CV could be much lower than market value. It certainly is in Auckland, for example. In other parts of the country, it might be much higher, so you'll win. But you'll certainly need to be considering that element of the valuation. Now, there's a few things that I'd like to say about CGT. First thing is that it's sort of sold as a solution to house price inflation. But when you look overseas, what you get is a lock-in effect out of CGT. Let's say property goes up, let's say you buy a property for $1 million, 10 years later it's worth $2 million. So there's an increase in value of $1 million. What people tend to do is, investors, is they borrow against the increase in value rather than selling. Just consider the $1 million gain on this property. If you sell a property, you'll end up paying CGT, and CGT would be 33%. It's your marginal tax rate multiplied by the gain, so 33% of the $1 million. So you'd pay $333,000 to the IRD in capital gains tax and get $667,000 in your hand, ignoring agents, fees, and lawyers' fees and so forth. So you've got 667 in the bank. Well, what if you simply went to a bank and borrowed 65% of the $1 million gain? You'd have 650,000 in the bank, and you wouldn't have to pay the tax. In fact, you could use the tax that you haven't paid to fund the next 10 years of additional interest cost that you're paying, say 5% of the extra 650,000 of debt. It's what, $32,000 of interest. You could pre-fund 10 years of that interest from the tax that you haven't had to pay, and then you get the additional increase in value on that as a gain. So this creates a lock-in effect. Rather than encouraging people to not invest in property, it causes people to hang on to their houses because people are not wanting to pay the tax. You also get a mansion effect out of CGT. So family homes are exempt CGT under most tax models internationally. So what people tend to do is they get very expensive houses and they make them bigger, better, because there's a tax bias towards home ownership that results from family homes being exempt CGT. So while the government's trying to use this as a lever to make investing in housing less effective, I really question its effectiveness as a tool for controlling house price inflation. Because if you actually look at why investors invest, it's not because the gains on property are not taxable, because the gains on shares are not taxable either. And if you bring CGT in, it will apply comprehensively to all gains, not just gains on property. It'll also apply to gains on shares and other assets you own, like businesses, chattels, even things like your family car. If you sell it for a gain, it could be taxable under a comprehensive capital gains tax. So one asset class, property, another asset class, shares, it's all going to be taxed evenly. And when you look at it from that perspective, people aren't investing in property to dodge tax because they're taxed the same way on shares as they are on property. They're investing in property because of the benefit of leverage. You know, if you can buy a property for $1 million and put a $200,000 deposit on it, gear it at 80%, you put 200 in, you've got $1 million going up in value. If that doubles in value in 10 years, you make $1 million on a $200,000 deposit. You end up with 1.2 million. With shares, you don't typically leverage shares. You put 200 grand into shares, you end up with 400,000 if they do the same as property. So where the bias to investing is coming from is not tax, it's the benefit of leverage. And for that reason, I think that CGT will be less effective as a lever to slow down investors' appetite in housing. And of course, the other factor which concerns me is that stamp duty would likely come in hand with CGT. So planning for CGT, it's impossible until we see the shape of the legislation. It's likely that it will be on property and all assets, but exclude the family home from the rhetoric from the government. V-Day is going to be important. There has been questions about whether inheritance tax will come in with this. I think you'll see trusts becoming much more popular with CGT because in the absence of some inheritance tax that looks through trusts and so forth, well, of course, people will just want to make sure that they don't own assets at the date of death because if their assets are in trust, then the trust doesn't die, but the individual dies. So I think prior to death, there'll be a lot of planning towards pushing assets up into trusts, and you'll see a real revival of family trusts in such circumstances. Now, tax avoidance, I think, is going to be a bit of an issue with CGT, and I'll give you an example of this. Let's say that two investors have family homes and they're worth $500,000. What if the two investors sell each of their homes, which are both worth $500,000, to each other for $1 million. Now they've got a cost base of 1 million, and they're not related parties. So what they've done is they've paid above market for these assets, and that would mean that the first $500,000 of gains on those properties would be non-taxable, because they've effectively concocted a value that's above market value. Now, that could easily be undone through a tax avoidance allegation from IRD, and they could unwind that by simply saying you've transferred assets at above market value, and that's an avoidance arrangement because it's non-market, and you haven't done this for any reason other than to gain a tax benefit. And so there'd be ramifications of that to the investors, but it raises the issue that there'll be all sorts of skullduggery going on with this tax. Another example is you buy a boat for 100,000 and resell it for 20,000, and it's sold from you to your family trust, and you get a valuation in support of the sale. Well, if it's a comprehensive capital gains tax, then you'll get a capital loss, which will be deductible, and so on and so forth. You can see the permutations of this. So this will be a difficult tax to police, because there'll be an awful lot of skullduggery and shenanigans going on in the tax base. Lots of people ask how capital gains tax works, and this is an example of it, and I'm going to use stamp duty in it. So here's a property. It's been purchased for $500,000 under current rules. 10 years later, it's worth $1 million, so net gain of $500,000. And we take out the agent's fees, $40,000, and that's about the extent of our current taxation. If you're a long-term investor, the gains are non-taxable, so that $460,000 is what hits your pocket. Now, under CGT, what you'd have is, firstly, potentially stamp duty. If it was 5%, 25,000. So you'd have a cost of $525,000. You then sell it 10 years later for $1 million, net gain of $475,000. Take out the agent's fees, and then, having deducted the agent's fees, the residual profit is taxable, $435,000, times by your marginal tax rate, in this case 33%. So 143 is the tax. You end up with $291,000 as your net surplus after tax. So you compare 460 to 291, it's 168,000 different. So the impact of CGT and stamp duty will be quite substantial. Let's move on to loss ring fencing, which is emerging policy from this government. And what we've seen recently in the last 3 weeks is an issues paper. So this conversation is May 2018, and just be aware that everything I'm discussing in here will change. So if you're viewing this webinar later, as these rules change and the legislation comes through, be aware that what I'm discussing could be different when the final rules come into place. But what we have is loss ring fencing rules. There's an issues paper that has been published, and it's saying that losses from residential property will be quarantined from being offset against non-property income. The proposed implementation of this is 1 April 2019 for the 2020 tax year. And in terms of application period, they've changed what they said they were going to do. They said in the election that they would bring this in over 5 years because they didn't want to shock the market. And the impact of suddenly taking tax losses off people can be quite shocking to a market if they're relying on that for cash flow to get back to a cash neutral situation. But these ring fencing rules have said quite specifically that their preference is to bring them in from day one, because that will be simpler. But if it doesn't come in from day one, then it should be phased in over 2 to 3 years. So that's the proposal. So this paper is effectively saying you can't claim your losses once these loss ring fencing rules have come in of anything except future property income. So PAYE investors or salaried investors or self-employed people with income that's not related to property, you won't be able to claim tax losses against that income. So it's residential property only, so it's aligned with the Brightline rules in that respect. So it's not related to commercial property, it's not related to farms. Interestingly, it does include overseas residential property. So if you've got Australian property or property offshore, your losses are going to be ring-fenced for those overseas investments. What they've said in the paper is that it will be applied on a portfolio basis. So you're going to be able to offset other property income with property losses. For example, revenue account property with capital account property. What I mean by this is if your loss is sourced from a long-term investment, capital account property, you'll be able to, under the draft rules, offset that against property that you've acquired with the intention of resale, development, or construction. So in other words, you can take your profits from your trading activities and offset them against the losses from your buy and hold property activities. It's also contemplated within that you could use the losses to pay property income caught under Brightline rules. So revenue account property would also capture those Brightline rule discussions, it would appear, from the draft rules. What is less clear is in terms of the definition of a portfolio basis. Okay, so we can offset revenue and capital profits and losses. What's less clear is whether you can take groups of entities and offset. So for example, if you had two companies owned by a trust, and one was a development company buying property to sell, making profits, and then you had another company that had buy and hold investments making losses. Under current rules, you could group those losses and profits using the corporate grouping rules, and you just offset them and utilise the losses intercompany. So does portfolio basis allow you to offset between two companies? We're uncertain at this stage. Another example of this would be two look-through companies. One is a property trader, the other is a buy and hold investor, owned by, say, a common trust. You would expect that the trust, being the transparent entity, so an LTC, you've got two LTCs here, they're disregarded entities for tax purposes. So the trust steps into the shoes of the companies. You have a revenue account loss or profit in one entity, and you have the long-term investment loss or profit in the other entity. Traditionally, the trust can just offset these because it's like a bucket. You tip the profit and loss into the trust tax return and wash them up together. Whether that will count for a portfolio basis offset is yet to be determined. So there are still questions about these loss ring fencing rules that haven't been answered in the paper that's requesting submissions. And as soon as we get the answers to these, we'll certainly be publishing it. Here's how loss ring fencing might come in. So this is an example of loss ring fencing being brought in over 2 years. And I'll just pause and say, you can see on the top right corner, you've got various boxes there, and you can ask your questions there. Somebody, Mr. McGill, has asked a question: trading trust losses can still be offset against rental trust profits. So loss ring fencing. Anthony, you there? Come back, Mr. Lipscombe.
Hi, yes, Matthew. So I got that question, and I suppose that if I heard it correctly, the mention was of the losses existing in a trading trust and the profits existing in a rental trust. So in actual fact, that would not be a scenario impacted by loss ring fencing, because the rental trust is profitable in this instance. So we're going in the reverse direction there. But if the position of the trusts were the other way around, and there were rental losses in a trust and profits in a trading trust, then number one, if those profits were not property related, then we could say with certainty that once these new rules come in, you would not be able to offset. but if those profits were produced by property trading activity, then as you have just mentioned a few moments ago, Matthew, we're uncertain as to whether the portfolio basis that they've proposed will allow alignment of losses and profits across different entities.
Yep, fair enough. So the point being that the trading profits and losses are not affected by this. It's capital account losses that are the ring-fenced losses.
Yep, residential property losses.
Yep, residential, yep. So I'm just looking at some more of these questions here. Will properties bought before the 31st of the 3rd still be under the 2-year Brightline policy? Well, it's 29th of the 3rd. So if you've acquired a property prior to the 29th, on the 28th of March, then you're under the 2-year Brightline policy. If you've acquired a property after the 28th of March, then you'll be under the 5-year Brightline rules. Somebody's saying audio's cutting out. That'll be your bandwidth. I'm sorry, I can't control bandwidth at your end. I'm on fibre, high-speed business fibre, so it's not my end. Am I still showing 2 slides? Oh, am I? Goodness, thanks, thanks, Greg. Greg's telling me I'm showing 2 slides. Lord knows how to fix that. Will properties bought before? Okay, that's another one. That's probably enough questions for now. Let's carry on. Okay, so here we've got, thanks Anthony, we've got a net taxable loss of 25,000, and you can see in an ordinary year you'd claim a third of that 25,000 as a loss, which is 8,300 as a tax refund, and so your after-tax cash flow is 16,667, and that's your full amount in an ordinary tax return as it stands now. If these rules came in for the 2019 tax year, which is the current year, then the same losses, if they stepped it in 50%, you would claim 12,500 of the losses, and your cumulative loss would be $12,500, which you would carry forwards. So you're only getting tax back on the step-in amount, which is 50%, so you get half the tax refund. Then the following year, when it steps in 100%, you can't claim any of the loss, so you carry forward the full $25,000 loss to offset against future income. So that income, of course, as mentioned, would have to be income derived from property on a portfolio basis. So it could be revenue account property or capital account. So, for example, you hold a property for a long time, and eventually it becomes tax positive if you're a long-term investor. You can use these losses to offset that in the longer term. So this is an issues paper only. Submissions close this Friday, the 11th of May, and we've put a submission in on this, on loss ring fencing. The gist of our submission is that the goal of these is to make owner-occupier ownership of housing easier. To which we say, well, where's the evidence that that's going to happen? There's no empirical evidence, there's no data to support that. What we would say is it's socially regressive, because people who need these losses the most are, plainly speaking, the poorer people who, and I know that's generalising, but Kiwi battlers who are getting on the property ladder, who are negative cash flow when they start out, and who are particularly vulnerable to spikes in interest rates. It's not such a big deal at the moment, but if you see a spike in interest rates, if you've got $1 million worth of investment property debt at 5% and you're cash neutral, at 10% interest rate, that becomes an extra $50,000 that you're having to fund on the same amount of money. Now, high net worth, high income people can easily cope with that extra $50,000 responsibility, but low net worth, low income people find it much tougher. So we think that's quite socially regressive, and you'd have to question Labor on this, because, you know, who are they beating up? They're actually beating up their own constituents. They're beating up their core voter base, you would think, who are trying to use property as a ladder to climb up, climb up the socioeconomic scale. And if you like, they're going to serve up their voter base to the national voters as victims, because if interest rates go up, the wealthy people are just going to buy all these assets at discounts. simply because the reduced tax benefit to the people that need it the most is not there. It's also inconsistent with principles of good tax law. There's a sort of matrix of things that make up good tax law, and they talk about things like horizontal and vertical equity. And so this is looking at things like, why would you treat business losses different from property losses? You start creating biases. Is there a compliance burden of the new tax that's proposed? Is it socially progressive? It's regressive in this situation. I think what we've got here is ideology reigning over common sense, because who this is intended to help, it's actually going to hurt. So we've made a submission, and we'll publish that submission on our Facebook pages at some point. I want to talk now a little bit about Airbnb, and I would really like to get rid of that second slide so you can't see my answers, because it makes my questions to you. You've got the answer. Right, but I can't, so it doesn't matter. We'll carry on. So let's talk about Airbnb, because this is an area that a lot of people ask questions about, and it's quite simple actually. So with Airbnb, what you've got is it's just normal taxable income. You put an asset up on Airbnb, the rents are taxable, the deductions are deductible per normal investment properties. You still get your interest and your operating expenses, rates, insurance, repairs and maintenance management fees. But what is different is GST applies because it's short stay accommodation. Residential rents are exempt GST. So with Airbnb, you've got short stay accommodation, it's not exempt GST. So here, if your turnover exceeds $60,000, then you're compelled to be GST registered. And if you're under $60,000, then you've got optional GST registration. Consequences of registration are, pointing out the obvious, you have your capital gains being subjected to GST. And it's worth saying at this point that the rules for GST and the rules for income tax are different. You can have a situation where you're taxable for GST under the GST rules, as you would be here if you're deemed to be registered for short stay accommodation, but the long-term gains are still not taxable in the absence of a capital gains tax. So non-taxable under income tax rules, taxable under GST. So let's say you bought a property for $500,000 and that was GST exclusive because it was short stay accommodation, and you then sold it for $1 million including GST. Then effectively you've got GST applying to the gain. You'd have GST on the gain between the $500,000 and the $1 million including GST. So take the GST out of the $1 million, you've got you've effectively lost the GST on the gain. So commercial outcomes are, firstly, you're losing GST on the capital gain, which is not a good outcome. Secondly, be aware that your insurance can get a bit trickier. You've got to alert your insurer that the nature of the use of the assets moved from long-term rental investment to short stay accommodation, and that will change your risk profile and potentially push your insurances up. And another factor, just be aware that councils all over New Zealand are looking for Airbnb properties listed on Airbnb. They're tracing them and they're loading up your rates because they're saying the use of the asset becomes commercial. So I've got a holiday home in the far north, tiny little town in the far north of Kirikiri, and I've noticed my neighbours have been targeted because they've got their property on Airbnb, and they've been targeted by the Far North District Council for commercial rates, which has infuriated them. And this is also happening in Auckland. I've seen it in Auckland a lot, so just be aware that that's a commercial outcome of going on to Airbnb. Let's move now to a more thorny issue and more mainstream issue that affects people buying at auction, and also just people who are dealing in land and property, developing or building houses. And this is the effective GST and deemed zero rating. So here, people who are GST registered for property, traders, developers and builders, the issue is that they risk purchasing a property as a GST inclusive asset, thinking they can claim GST on it, but it turns out that the vendor is GST registered, and with GST, if the vendor and the purchaser are both GST registered, the meaning of including GST changes. It switches from being you have the ability to claim GST to effectively saying you're not allowed to claim GST. And when you sell the asset, you then have to pay the GST. So this bites you in the pocket. So here's an example. You're GST registered, you successfully bid $1 million for a property, including GST, without knowing the vendor's GST status. And your bid of $1 million is on the basis that the vendor's not registered, so you can claim GST of $130,000. Turns out the vendor is GST registered, it wasn't disclosed. What's the financial outcome of deemed zero rating? Well, you're not registered, so let's just look at how it would be in the normal circumstances. You buy a property for $1 million, you would normally claim the GST, $130,000, and so the net cash you paid for the property, exempt GST, is $869. You then sell the property for $1 million, you pay the GST, and the net cash collected is $869. So cash in equals cash out, no loss or gain. But if it turned out that as a purchaser, the vendor was GST registered as well, and you're GST registered, you've got deemed zero rating. So you can't claim GST, your net cash paid is now $1 million. Now you go and sell that property for exactly the same amount, $1 million. Of course, you have to pay the GST, so you're now out of pocket by the GST, you lose the GST. So I guess the implication of this is make sure when you are bidding at auction, if you are GST registered, that you understand the GST registration of the vendor, because it's this is a way to lose money very quickly. You just lose the GST, even though the asset value is worth the same. Just the technicality of being caught out with deemed zero rating catches you for, in this case, $130,000. So in practice, it's worse than this, because we're seeing situations where IRD audit the claim on a property. So let's say you buy this property for $1 million, the vendor says they're not registered, and IRD come along and looks at the situation of the vendor and says, oh, actually the vendor to you, it turns out that we think that they are in the business of buying and selling houses because they've done this a number of times. So we're going to retrospectively register them for GST and deem them to be GST registered as a result of them auditing the vendor's situation. And so even though they've said they're not registered and they weren't registered, at time of claim, it turns out that retrospectively the IRD have said that they're going to make them GST registered. And then they retrospectively zero rate the transaction between the two parties, deny your GST claim. You then say, hey, this is ridiculous, it's totally unfair. And they say, well, it's a civil matter, you have to sue them and get the GST back. Another example of that is somebody who is in the business of subdivision, and you buy an asset off them and they say it's not part of their subdivision activity, so they'll sell it to you with no GST. IRD subsequently say it is part of their taxable activity, retrospectively say that the vendor should have been GST registered in relation to that transaction, and deem the sale to be subject to GST, which means you don't get to claim. And then this is an adjustment to the actual value you're paying for the asset. You actually end up paying more because you can't claim GST, and you then have to sue the vendor to obtain that loss back from them. And that becomes hairy. It depends on which version of the sale and purchase agreement you've signed. And what we give our clients is a clause that says if the vendor misrepresents their GST status, that they are personally liable, the director of the company and the named party signing. So if it's a company and the director of the company become liable personally for any loss resulting from misrepresentation over the GST status. So we did that after we saw one of our clients taken advantage of by what I could only describe as a disgraceful company that lied about their GST status and then jumped into liquidation straight after settlement. So they took the money, said they weren't registered, jumped into liquidation, appointed a liquidator, would you believe, that had been to jail. And so just a very dodgy circumstance where the vendors were lying about their GST status and then liquidating. So our client, who acted in good faith, believed that the vendor wasn't registered, put a GST claim in. IRD looked at it and said, no, we believe the vendor is registered in relation to this property. We're deeming this to be a zero-rated transaction. And in the absence of any other contractual mechanism in the sale and purchase agreement that said that they could recover it, they just had to sue the company. The company was in liquidation, and the liquidator was obviously biased and just denied liability. So we were absolutely furious about this and actually stood up for the client. We bought the debt off the client for $1, and because she was never going to make any money out of the claim, so we bought the debt for $1 and sued the vendor. And I had long discussions with IRD about the liquidator, about the vendors, about their accountants, and made it very clear to all parties that we thought that that this was a scheme. And in the end, we settled out of court with them and got the money. So that was a win. But most people don't have the appetite to go and scrap like that. And incidentally, we passed the benefit of much of that through to the client. So she was delighted because she held the vendor accountable, and she wasn't exposed to the risk of the litigation cost. But it was disgraceful that we had to do it. Now, mortgagee in possession. This is a GST issue. When you buy at mortgagee sale, the bank is in possession. So while it's in the homeowner's name or the company's name that owned the property, the bank has possession for legal purposes because they can deal with the asset and sell it to defray their losses. But the bank is compelled to charge GST and account for GST to IRD if the asset is GST registered. And the only exception to this rule is if the bank can prove that the property never had GST claimed on it. And that can be hard to do because if the bank is fighting with the vendor's not giving them the information, then the bank's potentially in the gun for the GST if they settle and don't account for GST on the sale. So I've had personal experience with this where I purchased a property off ASB. ASB were in possession as mortgagee. I was the buyer, and what they said was if it was $500,000, rough number, they said we're going to have to take GST out of the $500,000 and pay that to the IRD, and then the net sum applied through to the debt of the vendor would be, a lesser amount. So effectively, the vendor was being hurt, and it just goes to show that this is the mindset of the banks. They're going to hold the GST back unless you can prove that that GST has not been claimed on the asset, and that affects your ability to get GST out of it because it'll be deemed zero rated if they're doing that and you're GST registered. Or you could potentially have to pay more to get the same asset for them to let it go. Now let's just talk tax structures for a minute. Let's meet Bob and Siri. Bob and Mary. Bob and Mary wish to own a property portfolio, and their projected tax loss next year is $15,000. Bob's on 150 grand. Mary's a homemaker. She's not making any money. What should they do? So this is typical sort of structure here. The trust is going to own the family home. Bob will own the shares in a look-through company, and the tax losses flow through the company to Bob. And we try and keep Mary out of it because she's not earning income, so there's no point in giving her shares because there's no point in giving her tax losses. If she's got no income, you can't offset the tax losses through the look-through company, so you give all the shares to Bob. So this is a very common structure. It's on the front page of my book, and it's well published and well utilised, and this is mainstream investing. So you build a wall, the vertical red line is a wall between the trust that owns your home and the banks inside your look-through company. So you'd have different banks in your look-through company as opposed to the banks in your trust over your family home. So here's your very traditional structure, and the question is, do we still need look-through companies if losses are ring-fenced? So let's say, and this will be a common thing, I think, ABC accountants are saying, why bother with LTCs if you can't claim tax losses? And just think about a few things here. In the next 5 years, you're going to be funding $15,000 of losses, so you'll accumulate a $75,000 shareholder current account. And in the example earlier, I showed you the way you can recycle private debt into a company and make it tax deductible, quite a common thing. So in this case, if you've been pumping 15 grand a year into a company for 5 years, the company owes you $75,000. So you can call up that loan of $75,000 and repay private debt with it, and that's quite lawful. But if you've decided not to use a company in an LTC, an LTC is a company. So if you've decided not to use a look-through company, then actually you own the property, you've paid the debt down in your name. When you go to re-borrow the $75,000 back, then the intended purpose of that money to then put into your family home becomes private, which is non-deductible. So you still need to separate the legal ownership of the asset from yourself so you can build current accounts so that you can recycle debt later. And then you'd say, but why, Matthew? Because you can't claim the losses. Well, what about future capital gains tax obligations? I would imagine that if this portfolio basis is applying to revenue account transactions, that there must be some consideration given to using the losses accumulated against capital gains tax obligations. We don't know the answer to that yet, but that's a consideration. What happens when the property becomes tax positive? If you haven't accumulated your losses, you'll just end up paying tax on the profits from the rents. And also, what if you become a trader, developer, or builder? You'll want to use these losses and profits to offset against, on a portfolio basis, your other incomes. And what about the very common situation where you have people that own a family home and they decide to turn that into a rental property and purchase a new home? And so that situation, if they don't form an LTC, they have a rental in their name and they buy the new home in their own name, they're borrowing the money for the new home in their own name, that's non-deductible. And then the existing home, but which becomes a rental property, which could potentially have no debt over it, or perhaps a small amount of debt. That small amount of debt or asset with no debt now has rental income coming in. And so all of the rents become assessable income. You've got no tax deduction for the interest on the property. So you'd end up paying tax. If you had $600 a week of rent coming in and no interest deduction, you'd have $30,000 worth of income, $6 grand worth of operating expenses, say, you'd end up paying tax on $24,000. Whereas if you shifted the property, let's say it's $1 million into a company, an LTC, you've got 50 grand worth of losses. You can offset 50 grand worth of interest. You could offset the 50 grand worth of interest against the $24,000 worth of net yield after operating expenses, rent minus operating expenses, and you'd have a loss of 26 grand. But you don't pay any tax on the 24 because it's sheltered by the interest that you're deducting against it. Of course, the other 26 grand becomes a loss that you carry forward to offset against future income. But if you don't transfer the asset into an LTC, you get none of the interest deductible. So there'll be lots of debates surrounding whether LTCs are useful or not. Another one would be, what about another change of government? You know, suddenly you've moved all the assets into your own name. The new government comes in and says that this loss ring fencing is socially regressive. We're going to chuck these rules out. If that happens, you'll then want to move your investment portfolio into an LTC and step up the value, but you're caught by 5-year Brightline rules, so you won't be able to do it for 5 years, all this sort of thing. So we would say we can still see merit in LTCs long term, but you'll just have short-term loss ring fencing going on. So that's what I've got for tax. I just want to now change topic. Shall we just pause, Anthony, and see if there's any more questions here? I'm sure there's more coming in. Do you want to unmute yourself, Anthony, and come back in?
Sure.
Would you need an LTC to achieve this, or just an ordinary company? Either. So, you could move the asset into an ordinary company, and that would give you the same outcome, because whether it's an LTC borrowing or an ordinary company, you're still going to get a deduction for the interest when you step the asset across. Does it mean at Mortgagee sale, the sale price is GST exclusive? Anthony?
No, I would class the sale price in a typical mortgagee situation as being, I call it subject to GST. So I would say that it includes a GST. But if the purchaser is GST registered, then we've got a zero rated transaction, so the GST component is zero. Then it's somewhat academic whether you call it inclusive or not. The point is that as a GST registered purchaser, and therefore somebody who would otherwise anticipate getting a GST claim, you've got to be very careful when buying at mortgagee auction, because the default position is that the mortgagee will be regarded as a GST registered vendor.
Something from Michelle here. If someone buys a property to let on Airbnb, can they always claim the GST on purchase price unless zero rated, even if they expect to collect less than $60,000 of income? I'll let you deal with that, Anthony.
Sure. Well, if your gross expected annual income from the Airbnb activity is anticipated to be less than $60,000, you can voluntarily register for GST. So in response to Michelle's question, one could say yes, GST can be claimed in a situation where you are going to apply a property towards Airbnb use, even if the turnover is less than 60. But one would have to question whether you would want to do that. Sure, it'll give you a short-term sugar hit in terms of cash flow at the time of purchase, but it does, of course, come at a potentially long-term significant cost, because you're now having to return GST on your Airbnb income, which won't be, the income won't automatically adjust upwards by 15% to account for the fact that you're now paying GST. And of course, you'll have the long-term ramification of having to pay GST on sale, which, as Matthew's pointed out before, effectively means you lose GST on your margin.
Great. And Bob Bell asks, if the vendor and purchaser are GST registered, can the purchaser buy sale price GST exclusive of GST and have the transaction zero rated? Yes, they can, if they're both GST registered. Lots of people are telling me to click the display settings at the top, but I can't do that and ask questions at the same time. Will CGT apply if rentals in a rental trust are passed on to the children who are beneficiaries of the trust currently? Paul, we don't know the answer to that because we haven't seen the. Firstly, CGT's not in. Secondly, they haven't proposed rules. But I would hazard a guess that if you sell a property from a rental trust to a child, that is the disposal of property. So the difference between cost and market value would be taxable on the gain. And that's what it would have to be, because a trust is, for tax purposes, a separate legal entity. So you've got a disposal for tax purposes. If using LTC, what about tainting? If you would become a trader or a developer, what type of structure would you choose? That's a long question, but you can't break tainting anymore. If you hold a property for 10 years, then it loses its tainted status. So tainting is where you're buying and selling property, buying and holding property. The hold properties become taxable if sold within 10 years. So hold them 10 years, they lose their tainted status. So what sort of structure would you use? That is very much an individual situation that would give you advice on one-to-one. What happens if I buy a property off the plans? Oh, Sorry, I just lost my place here. There it is. Ash, what happens if I buy a property off the plans and sell it on completion? So if your intention is to keep it long term, Ash, and you have a change of intention, off the plan sales, your acquisition date is the date that you signed the agreement, and the Brightline rules will run from the date you signed the agreement. So if you've signed an agreement after the March 29th and you sell it within 5 years, you're caught within Brightline rules, assuming it's residential investment. If it's your family home, then potentially non-taxable if you had a change of intention.
Although one qualification there, Matthew, if the facts that Ash has set out mean that they don't actually settle on the property, even if they intended it to be their home, if they don't actually live in it, then you wouldn't get the main home exemption. Obviously, you're talking about we settle it and live in it.
Yeah. How does the Brightline apply? Well said, Anthony. How does the Brightline apply if you bought a property before the 31st of March, then you subdivided that property from 1 into 2, and you built another rental on it on, say, the 1st of October 2018, which Brightline rule applies?
Okay. Shall I take that one?
Yep.
So the creation of new titles does not generate a restart of the Brightline clock. So in this situation, if this property were bought with a sale and purchase agreement entered into before the 29th of March, remember that people seem to be confusing the 29th with the 31st, they're very close, but obviously not the same. If the sale and purchase agreement we entered into before the 29th of March, then we have a 2-year Brightline period. And if that property, after being settled, is subsequently subdivided, the subdivision does not give rise to a restart of the 2-year clock. The 2-year clock runs from the point of settlement and will finish 2 years after settlement. For the sake of completeness, if a subdivision is completed in relation to land, then the Brightline is not your only concern here. There are a multitude of other provisions in the Income Tax Act that can apply to the sale of land, like the tainting provisions that Matthew's already mentioned, and there are some that specifically target subdivision. So you'd have to be wary of that as well, although there is an exemption if you are subdividing to generate rental income.
Thanks, Greg Kennan. Finally, we're going to get this webinar to work. And thanks, Anthony. Let's move on. So why is Auckland growth so strong? This is a supply and demand story. Here's latest data, end of March 2018. Auckland's up 102% from the bottom of the GFC price of, you can see there, of early 400s. So house prices were roughly just a tad short of 450. They bottomed out at about 425 during the GFC. And from the bottom of the GFC to the current position, they are up 102%. What's spectacular about that, apart from the growth, 100% growth over that period, 11 years, 10 and a quarter years. But what's spectacular about it is the lack of volatility. Auckland only went down 4%. And a lot of New Zealand went down 20%, and some of New Zealand went down 50%. This is a rolling average it's a rolling 90-day average of medians. So this is median house price, CoreLogic data, and I'm taking a rolling 90-day average of it because it gets rid of outlier statistics. If there was one property sold in March 2009 and it was a mortgagee sale, then it would be a non-representative sale. So taking the rolling 90-day average gets rid of that. So here we have a graph of demand, which is household formation, people coming to Auckland, and you can see that the people coming to Auckland divided by the average house size of 3, which gives you the number of houses forming, is far exceeding the supply. And that is a long-term trend, not a short-term trend in the last 10 years. So I think I'm just checking my screen settings here. So that is under Auckland's resilience. Also under Auckland's resilience is our high average income, second highest in the country, close to 100 grand per household, just short of it. and second only to Wellington, which has the government as the employer, the main employer down there. But what's really resilient about Auckland is our breadth of employment. We've got white collar, blue collar employment here, infrastructure spend up, housing spend up. It's just a very affluent society here, and it speaks to the resilience. We only went down 4% during the GFC, rest of New Zealand significantly more. And I think that's relevant to investors, because if you put $1 million into an investment, do you want to be in an area where the million can become 500,000 mid-cycle or 800,000 in other areas, depending on how much volatility? Auckland is a lot less volatile. CBD apartments, just a quick comment, they're well and truly in decline. I've never been an apartment fan. I own a couple of them, but I buy them when the markets crash. They're volatile because the banks tend to withdraw funding support for them during periods of recession. So where they'll still lend on house and land, you can see back in 07, 08, 09, apartments are all over the place, but house and land is still less volatile and heading in the right direction. So apartments are coming back, and I think that's well and truly to be expected. So net international migration, if you look at it, Auckland's quite recession-proof because people come into Auckland to get a job when rest of New Zealand is feeling the pinch of the recession. So rest of New Zealand is the brown, blue is Auckland, and you can see in these periods where rest of New Zealand's got a declining population, Auckland's actually still growing. So that speaks to our resilience. People come to Auckland to get a job, and that underpins demand for housing, which makes us less volatile in the down market. It's the same graph showing the same thing. The region's shedding population while Auckland's staying positive for internal and international migration during periods of recession. Some people say, well, this is a short-term thing. I say it's a long-term thing. You can see back to the 1950s, Auckland took off on population growth. Rest of New Zealand's remained kind of stagnant. So don't think this is a short-term factor. If you look at net population of 1.5 million people in Auckland, growing at 0.8%, 1% of 1.5 million is 15,000 people. So 0.8 of that's what, 13,000 odd, 14,000. So you've got that divided by 3, near enough to 4,000 houses, just to meet the pace at which the population is breeding. 4,000 houses just to meet organic growth requirements. So we looked at this earlier, and median house prices soft in Auckland, but still quite resilient through the rest of the country in the last 12 months. And I think it just speaks to what I said earlier. Auckland is the centre that goes on the boil first, it booms first, and then ripple effect pushes the population out of Auckland, so the rest of the country booms behind Auckland. Auckland goes first, and we're seeing that play out in this cycle. So a bit of real estate agent feedback. I was going to do some detail on this, but to be honest, I'm out of time. I want to finish at 8:30. But the gist of it is, I spoke to a West Auckland Barfoot's agent, and she's saying to me, West Auckland's selling faster. There's a small drop in prices. Things are a bit slower to sell, but there's actually a shortage out west at the moment. She's short of stock. This is Ying Lee Howe, who's a top West Auckland agent for Barfoot's. Her auction clearance rates are 32% as an average for Barfoot's, but higher out west, closer to 50%, and most things are selling after auction. She's noting a shortage of supply out west at the moment for listings, and rents are $600 a week plus for 3-bedroom houses, which is phenomenal. I then spoke to another Barfoot's agent down South Auckland today, Rohit Sharma. He's a very good Barfoot's agent. And he said to me things are taking a lot longer to sell. Auction clearance rates in Barfoot's down south are quite low. They can be as low as 20% in the week. Lots of buyers and activity at the moment. He said that building reports and valuations were causing finance to fail. And he said that buyers were being a bit more conservative, the banks being very conservative, and this is causing asset values to come off the boil. He said he's seeing houses that were being sold in Manurewa for $650 last year, for selling as little as $550 this year. He reckons that some houses are being sold $100,000 off. Against that, he said that rents are going through the roof, and I've heard anecdotally that through that feedback through my client base. Celeste Chan, one of our accountants, he told me that he's seen some properties rented that are 3-bedroom nice houses in Favona, Mangere, so new houses, but they're being rented for $700 a week, 3-bedroom houses. Go figure, it's quite a high price. So sort of mixed messages. Rents are going up, but house prices are falling down south, so it's making home ownership more attractive. And there are certainly a lot of new home buyers or first home buyers down South Auckland, according to Rohit. Lots of supply on the market, he said, investors cashing up and running, new home buyers everywhere. They're struggling to get bank finance, and things are taking longer to sell, especially difficult because the banks are being stricter, he says. I then spoke to a Ray White agent, Megan Jaffe, who's my sister at Ray White in Mangere, very successful agent. She's Ray White's top agent globally, number one agency globally, amazing, over 1,000 offices. And she sells 400 properties through her agency annually at an average price of $2 million per property. So this is high demographics in Auckland. She said her auction clearance rates are 11% pre-auction, 38% under the hammer, 23% post-auction just after, so 72% clearance. And she said prices are flat in the Eastern Corridor. Buyers are a bit fewer and far between, but there are a lot of quality buyers, and they are prices are holding flat. That was her feedback. So, mixed bag. South Auckland's always volatile. Under the unitary plan, there's so much opportunity. This sort of thing, it's a dime a dozen in Auckland now. Auckland's been rezoned. Here's a site that I bought. It's terraced housing and apartment building zone. And you can chop it up and turn it into a full lot subdivision. And on this one, I paid $725 for it. And you can see on the right here, with my subdivision and build costs, I'm making $785,000 to $885,000 on it, quite high margins. So this sort of investing is very popular. One of the things we're doing for clients is we're doing option analysis. So this is where we go through our assistance programs with clients, where we give them analysis on their existing site to do a review and capability study, introduce our clients to our supply chain of people with development experience, or run them through our education courses. So this is a property you can see where we've gone through and looked at 6 or 7 different options and worked out the best one, which is the highlighted one in yellow. So if that's of interest to you, come to our courses, come and see us at GRA. I've got around 30 houses in Auckland. This is one on Ash Street. You can see a whole bunch of weatherboard houses. I take a site like this and I smash it up with my digger. That's my digger. And a lot of fun smashing the house up. There it is. And then we clear the site out and send all the dirt to the dump. And it's about where it is at the moment. So we're just developing it at the moment. It's a 127A Ash Street. That's under subdivision. I've got one at Withers Road, one at McLeod. I do lots of this stuff and lots of money in it. And it's something you can do in the current environment that's making money. And look, if this is of interest to you, what I'm discussing tonight, whether it's the tax or whether it's the investing, we are tax and property advisors. You can use us for accounting or use us for property advisory, whatever you like. You can book a free tax consultation, gra.co.nz, or you can email us, that's my email on the right, mg@gra.co.nz, or amandac@gra.co.nz is our marketing manager. So just get in touch or go to our website and book online at www.gra.co.nz. Got some good books out. Property 101, if you haven't read that, it's all about how to make money out of property and the New Zealand property scene with a focus on Auckland, and Tax Structures 101 being another option for you looking at the optimised structures. I said that the trust in the LTC was in the front of my book. There it is right there. So you can get those books at our GRA web. There's the web address there. We run fortnightly seminars. They're property information evenings on how to invest in property, and I give market commentary. I usually take these. So if you want to hear more from me, jump on our GRA web and book and come and have a listen to us. We also have a school which you can book into at our event centre. This is a 7-week course covering everything from, analysis of regional investing to supply demand curves to all the different strategies under the unitary plan, which are available. Particularly flat conversions are hot at the moment. You can put a flat into an existing house. Didn't used to be able to do that, so we teach that at the school. Property development, option analysis, all that stuff. So we've got a school. If you're interested in that, you can read about it under our event centre. Just click Property School. Last thing is I've got the Property Leaders event, May 27th. It's myself with Tony Alexander, Ashley Church, Chris Peterson, and Tuasar Sevi, all experienced property people and economic advisors. Come and have a listen to all of us. Janet Sukawa from GRA and Celeste Chan from GRA will be there. Come and have a listen to us. Tickets are $45. It's at the Ellerslie Event Centre. You can book online. We'd love to see you there. We've only got 50 tickets left. So it's an Auckland-only event. We won't be filming it. Do come and have a listen. We'll tell you exactly what's going on with that market update from these property leaders. I'd like to take this opportunity to thank you for listening to this update. I hope you found it educational and useful. I'd also like to thank Anthony Lipscombe for coming along and helping us with Q&A. If anybody has any questions, just jump on our web. You can make contact with us there. We've got the opportunity to book a tax meeting, or if you want your annual accounting done with us, you can also book that online. Thanks very much, everybody. Look forward to seeing you at one of our events, and thanks for listening. Good night.